Well, it's good news for the US as American consumers are growing more confident about the job market. Companies are ordering more equipment and home prices are rising in most major cities according to the plethora of data released this week. Joining me down the line to discuss is Peter de Bruin. So Peter, the latest batch of government data suggests that the economy is improving just as the holiday shopping season begins. Do you think the data is a true sign, however, that the economy is on the mend?
Well, I would be a bit careful in saying that. I mean, you're right in your assessment about the American consumer, as well in your assessment about house prices. They're both sharply up. However, companies are very cautious about the pending fiscal cliff and have postponed their investment decisions. And we already saw a weakness in investment in the third quarter, and we expect that to have continued in the fourth quarter as well.
Those trends could boost economic growth slightly in the final 3 months of the year, but according to some, the real payoff could come as early next year if the automatic tax increases and spending cuts known as the fiscal cliff can be averted. Do you think this is possible, though?
Well, partly. I do think that we'll see a slightly higher pace of fiscal consolidation next year than this year. However, we will most likely not see all the measures of the fiscal cliff being implemented. So the fiscal cliff is roughly about 4% of GDP. That's way too much fiscal consolidation than what the economy can handle. So I think that in the coming months we're going to see a deal between Democrats and Republicans where probably you see fiscal consolidation to the tune of 1.5% of GDP. So that means that you get some slower growth in the first half of next year, but still for the entire year the economy should be able to grow at around the same pace as this year.
It has been said that the problem with the focus on current consumption is that it does little to promote the future growth potential of the economy. For once these goods and services are consumed today, they provide little if any productive support for the economy in the future. Do you believe the same can be said for the American economy?
I do not necessarily agree with that. I mean, we know that after the recession, potential growth fell, which is a natural reaction, and it's something you tend to see after most recessions. However, given the severity of the latest recession, it was more, or the decline in potential growth was more than what we after previous recessions saw. But we also know that as the economy recovers and more people find a job, potential output tends to rise. And obviously for the economy to recover, in particular in the US, where consumption amounts to 70% of the GDP, you need stronger consumption. So I think that in essence what is going to happen in the coming years, so not next year but in say the coming 5 years, is that the consumer is going to help the US to get a slight rise in its potential growth rate again.
But how would you describe market behaviour at present? Is it risk on or risk off in your opinion? We
saw the market being in a risk off mode for the largest part of the day yesterday, and that was of course because the day before yesterday Harry Reid had said that the fiscal cliff negotiations were making very little progress. However, we also saw President Obama and House Speaker John Boehner, who yesterday said that they were making progress. We're seeing some mixed signals about the U.S. government being able to deal with the fiscal cliff. At any rate, today the market is in a risk-on mode. I mean, in European markets are all up. Euro-dollar is up, as are 10-year yields in the US a bit. So, but what you really see, and that's the main message, is that one day the market is worried about the fiscal cliff, the other day the market is a bit relieved about the fiscal cliff, and it's really a very strong driver of what markets are doing at the moment.
So the US economy likely grew faster in the third quarter than initially believed, but what are you expecting from quarter four?
Judging what we saw from inventories and net trade, we're looking at an economy that grew probably around, say, 2.6% in the third quarter. Well, for the fourth quarter, companies have been very careful with investing, and that's probably going to keep the overall growth rate a bit down. Right now, we're looking at growth of around 2%. But given the ongoing debate about the fiscal cliff, and let me stress again that we think we only see an outcome at the end of the year, so we're not that positive about it. We're going to see very, very little, if any, investment in the fourth quarter. Also, of course, there's the impact, or there has been the impact of the Hurricane Sandy, which means that the risks are pretty much to the downside. Although, at the moment, we have penciled in still fairly robust growth of around 2%.
Taking all of this into consideration, what is your outlook for the US dollar moving forward? What will be the main factors driving it?
We think that overall we see fiscal consolidation of around 1.5% of GDP next year. That should enable the economy to grow by, say, around 2%. Well, I mean, if we look at the Eurozone economy, I mean, obviously if we're going to say something about euro-dollar, we should also look at what's happening in the Eurozone. There we see a broad stabilization in the economy. So overall the US economy is likely to do better than the Eurozone economy next year, and we think that's also going to have an effect on euro-dollar. That's why we see euro-dollar at around 1.15 towards the end of next year. So we see strengthening of the US dollar next year.
Peter, thank you so much for your time and perspective today. That's all for the moment, but please do click back for more exclusive interviews from the TV team. Bye for now.